All right, so we're back for another deep dive, and today we're going to be looking at a chapter called How I Earned 300% Returns.
Okay.
It's from a book about, financial strategies and stuff like that.
Mm.
And what really caught my eye about this chapter is, the author kind of starts out, feeling a little bit lost in the world of just like traditional investing, like stocks, mutual funds, that whole thing. And they actually ended up with less money after 11 years of doing that.
Wow.
So I bet that resonates with some people out there.
Yeah, I'm sure it does.
But then they find a different path, and it's pretty impressive what they end up doing.
It is interesting how, like, so many people feel that way. Like they're stuck in a system
Yeah.
that's not really working for them.
Right.
And then to see someone, like, break free from that
Yeah.
and achieve these kinds of returns.
And pretty quickly, too. Like,
Yeah.
we're talking 3 years. But, before we get into, like, all the details of how they pulled it off,
Yeah.
I think it's important to just kind of, like, unpack that initial feeling,
Yeah.
that disillusionment they had.
Right.
They spent 11 years in the stock market, mutual funds, and ended up with less than they started with.
Yeah, it just really points to the importance of, like, having a solid strategy,
Yeah.
especially with the markets.
Right.
And I think this whole story reminds me of Warren Buffett's famous rule. Have you heard this one? Rule number 1, never lose money.
Mm-hmm.
Rule number 2, never forget rule number 1.
Oh, yeah.
So just minimizing loss is like the bedrock of wealth building.
Totally. Like, sometimes the best offense is a good defense.
Exactly.
But the author doesn't just say play it safe. They have this analogy, and I think it's really interesting. They compare smart investing to, have you ever seen the show Shark Tank?
Oh, yeah, of course, yeah.
Okay. They compare it to the strategies that the billionaires on that show use.
Interesting. Yeah, those guys they're really good at, like, assessing risk, right?
Yeah.
They don't just throw money at any idea.
Right.
They're looking for, where the upside outweighs the potential downside.
Right.
And I think that's what the author was talking about here.
Yeah. They call it smart risk.
Oh, okay.
And this plays a big role in their success story.
Okay, cool.
Yeah. So it's not about avoiding risk, right? It's about being strategic, being calculated.
Yeah.
And speaking of being calculated, let's talk about 2008.
Oh, boy.
The market crash.
Big one.
Huge. Sent shockwaves through, the world of finance.
Definitely.
But the author claims they didn't lose a single penny
Wow.
during that downturn.
Really?
Their secret weapon.
What's that?
Cash value life insurance.
Okay, this is where it starts to get really interesting.
Right.
Because, most people just think of life insurance as like, death benefit.
Yeah.
But it can be a powerful financial tool. And that's what the author used, specifically the cash value component to, weather that storm.
Okay. So I think for a lot of people, like, when they hear cash value life insurance, they're like, what?
Yeah, exactly.
Can you break that down a bit?
Sure. So cash value life insurance, it's a type of permanent life insurance, and it lets you build savings over time.
Okay.
And those savings grow tax deferred, and you can borrow against them.
Oh, so it's like having this secret stash of money.
Kind of, yeah. You're borrowing from yourself.
Okay.
So the interest rates are usually pretty good.
Gotcha.
And that's actually what the author used, those borrowed funds, to buy some real estate during the crash.
Oh, so that's how they avoided the losses
Yeah.
and then also capitalized on it.
Yeah. They saw it as a buying opportunity.
Yeah.
And they had the funds to do it.
Did they say anything about like what kind of properties they bought or how they found the deals?
They did. And it's crazy. They got 2 properties for the same price as they were back in 1984. Wow. Oh, my gosh.
Like, talk about a steal.
Okay, that's smart risk in action.
Right.
So they had the foresight to build up that cash value,
Yeah.
and then boom, they just swooped in and got these awesome real estate deals.
Exactly.
Okay, I'm starting to see how this is all connecting.
Yeah.
But what happened next? Like, did those real estate investments, did they pan out?
They did. Big time. So within 3 years, those properties, they more than tripled in value.
Oh, wow.
Yeah. And the rental income from those properties covered their entire initial investment.
So not only did they avoid losses during a huge crash, they also made incredible returns
Yeah.
through real estate, and all within, 3 years?
Yeah. And it really shows you the power of like thinking differently about money
Yeah.
and using these tools in kind of unconventional ways.
Right. I'm curious, do they go into detail about how they structured their cash value life insurance to make all this possible?
They did touch on some of that.
Oh.
And it gets pretty fascinating.
So for instance, they talked about how their policy was like specifically designed to be flexible when
Oh.
it came to like borrowing and repaying.
So it wasn't just like an off-the-shelf kind of
Yeah.
policy.
No, it was tailored to their needs and their goals.
That makes sense. They were very intentional about like setting things up
Yeah.
to give them that freedom to jump on opportunities
Exactly.
when they came up. Huh. This whole idea of using cash value life insurance to build wealth is really interesting to me.
Yeah, it's definitely something that deserves more attention,
Right.
especially for people who are looking to grow their money safely.
Yeah. But I also want to circle back to something you said earlier about Warren Buffett.
Okay.
You know, that rule of never losing money.
Right.
How does this strategy fit into that philosophy?
Yeah.
Because at the end of the day, all investments have some risk.
True.
Hmm.
But I think the author approached risk in a very calculated way. They weren't gambling.
Right.
They were making decisions based on research and analysis. And that cash value life insurance
Right.
was key to mitigating that risk.
So it was like their safety net.
Yeah, exactly. It was growing steadily over time, regardless of what the market was doing.
Hmm.
And they could borrow against it so they didn't have to sell off assets
Right.
or touch other investments when the market tanked.
It's like having a backup plan built right into your financial strategy.
Exactly.
That's pretty smart. But, I can't help but think about all those people who did lose money in 2008.
Yeah.
Do you think this approach could have helped them avoid those losses?
It's hard to say for sure,
Yeah.
but it does make you wonder.
Right.
Like, what if more people had understood these kinds of strategies?
Right.
What if they had known about cash value life insurance?
Yeah.
Could it have made a difference?
Yeah, that's a really good point. And it kind of leads me to another thing the author said that I thought was interesting. They said, greed has shaped the investment community, rigging the game against the individual investor. That's a pretty bold statement.
It is. And it definitely deserves some unpacking.
Yeah.
I think in the next part of our deep dive, we should really dig into that idea
Cool.
and see if the traditional financial system really is serving people's best interests.
Okay. Sounds good. Okay, so we're back and ready to really unpack this idea that the financial industry might not always be, playing fair
Right.
with the average investor. That was a pretty strong statement the author made.
It is a pretty provocative statement.
Yeah.
And I think, it's important to approach it with a critical eye, right?
Yeah.
It's not about demonizing the whole industry.
Right.
But there are definitely, incentives built into the system that might not always align with, what's best for the individual.
Right. So how do we as individual investors, how do we navigate that? What are some red flags we should be looking out for?
I think first and foremost, you got to be wary of anyone who promises quick riches or
Yeah.
guaranteed return.
Right.
The financial world is just way too complex for that. There's no magic formula.
Yeah.
If something sounds too good to be true,
It probably is.
it probably is.
Yeah, it's like if it walks like a duck and quacks like a duck.
Exactly.
But I think, it's easy to get caught up in the hype.
Oh, yeah.
Especially when you see all these ads and it seems like everyone else is getting rich except you.
Absolutely.
Mm-hmm.
And that's why it's so important to educate yourself.
Right.
Do your due diligence.
Mm-hmm.
Seek out different perspectives.
Right.
Don't just rely on one financial advisor, or one source of information. Read books. Listen to podcasts.
Mm-hmm.
Go to seminars.
Mm-hmm.
Talk to other investors.
Yeah.
The more knowledge you have,
Yeah.
the better decisions you're going to make.
Right. But that can also feel overwhelming, can it?
Oh, absolutely.
I mean, there's so much information out there. It's hard to know where to start. Do you have any tips for cutting through the noise and finding sources that you can actually trust?
That's a great question. I always tell people, look for sources that are transparent
Okay.
about their fees and their conflicts of interest.
Hmm.
So, a good financial advisor, they should be upfront about how they get paid
Right.
and whether they get commissions for recommending certain products.
That's a good point. Transparency is key.
Yeah,
And I guess it's also important to remember that, no one cares about your money as much as you do.
exactly.
So don't be afraid to ask questions, challenge assumptions, push back if something doesn't feel right.
Yeah, you hit the nail on the head. It's your money, your future.
Mm-hmm.
You have a right to be informed
Yeah.
and make decisions that are in your best interest.
Right. Be your own advocate. I love
Yeah.
that.
Yeah.
I want to go back to the author's story for a sec.
Okay.
They got these amazing returns in a very short amount of time, just 3 years.
Right.
What can we learn from their experience about timing and opportunity recognition?
That's a great observation. The author was clearly really good at spotting opportunities,
Mm.
and they weren't afraid to act. They saw the 2008 crash not as a disaster, but as a chance to buy assets cheap.
Right.
You know, they were ready, financially and mentally,
Hmm.
to seize that moment.
Yeah. It's like that saying, luck is what happens when preparation meets opportunity.
Right.
But it's more than luck, right? It's about having the right mindset, the right tools, the courage to take some calculated risks.
Totally.
Yeah.
It's about being proactive and creating your own luck.
Yeah.
You know, they didn't just sit around waiting for things to happen.
Right.
They took control.
So what can we learn from their real estate strategy? They mentioned buying 2 properties at a price that was the same as it was back in 1984. Like, how did they find those deals? What kind of due diligence did they do?
They were pretty detailed in their account of the process.
Okay.
They really emphasized research and analysis. You know, they didn't just jump on the first deal they saw.
Right.
They spent time understanding the local market, looking at property values,
Mm.
evaluating the risks. They also talked about having an exit strategy
Okay.
before making any investment.
So it sounds like they had a very systematic approach.
Oh, yeah?
It wasn't just like throwing darts at a board.
No, they had a plan, and they executed it well.
Okay. So now let's talk about the elephant in the room.
Okay,
Cash value life insurance.
right.
You mentioned it can be a powerful tool,
Yeah,
but I think a lot of people are still skeptical.
sure.
You know, they see it as something that's pushed by like insurance salespeople who are just trying to make a commission.
Yeah,
How do we separate fact from fiction when it comes to this stuff?
that's a valid concern.
Yeah.
And you're right, there are definitely some bad actors out there
Right.
who misrepresent the benefits, but that doesn't mean the product itself is bad.
Right.
It's a tool,
Okay.
and like any tool, it can be used for good or bad.
So how do we make sure we're using it for good?
Yeah,
Like, how do we find an advisor that we can actually trust?
that's the million-dollar question.
Right.
I think it starts with education.
Okay.
The more you understand about cash value life insurance,
Mm-hmm.
the better you'll be able to ask the right questions
Right.
and spot any red flags.
Mm-hmm.
I'd also recommend looking for independent advisors,
Okay.
ones who aren't tied to a specific insurance company.
So you know they're recommending what's actually best for you,
Exactly.
not just what's going to earn them the most money.
Right.
That's a good tip. And I think it's also important to remember that, like, this is not a one-size-fits-all solution.
Oh, absolutely not.
It's a complex product. It might not be right for everybody.
No. It's important to understand your goals, your
Yeah.
risk tolerance,
Mm-hmm.
your overall financial situation
Right.
before you make any decisions about it.
Okay. So it sounds like finding the right advisor is really key here.
Yeah.
But how do we go about finding that person? Do you have any like specific recommendations?
Well, I'd start by asking for referrals
Okay.
from people you trust,
Mhm.
friends, family, colleagues. You can also check with professional organizations
Okay.
like NFPFA,
Okay.
the National Association of Personal Financial Advisors.
Right.
They have a directory of, fee-only advisors.
Okay, so that's a good starting point. And I guess, do your own research too, right?
Oh, absolutely.
Look up their credentials, read reviews.
Yep.
Make sure they have a good track record.
Exactly.
Yeah.
And don't be afraid to ask tough questions.
Yeah.
Find out how they get paid, what their investment philosophy is,
Mhm.
how they would approach your specific situation.
Right.
A good advisor should be able to explain things clearly
Right.
and answer your questions in a way that you understand.
Yeah, I think that's a great piece of advice. Don't be afraid to ask tough questions. And if
And-
you're not comfortable with the answers, walk away.
Yeah, absolutely.
Find somebody else.
You deserve to work with someone you trust.
Right. Someone who's got your back.
Exactly. It's a partnership. You got to find someone you can communicate openly with.
Yeah. Yeah, for sure. Okay, so before we move on, I want to touch on one more point that I think is really crucial when evaluating any investment strategy,
Okay, I'm all ears.
especially one as, unique as the one the author used. It's the importance of, like, considering the bigger picture.
Right.
The author's story is inspiring.
Yeah.
The results are amazing. But we have to remember that, like, their individual circumstances, their risk tolerance, the market conditions at the time, all of that played a role.
Right. It's not a guarantee.
Right. So we can't just copy their strategy and expect the same results.
Exactly. It's about understanding the principles,
Yeah.
the thought process,
Mhm.
the factors that contributed to their success.
Right. So it's more about learning from their experience and then applying those lessons to our own situations.
Exactly. And that's where having a good advisor can be so helpful.
Yeah.
They can help you analyze your situation, find opportunities, and build a strategy that works for you.
Right. So it's not about finding some magic formula or a get-rich-quick scheme.
It's about understanding the principles,
Yeah.
making informed decisions,
Right.
taking calculated risks that align with your plan.
I love that. So it's about being proactive, taking control, making choices that, really support your long-term goals.
Exactly.
Okay, so I know we've covered a lot, but there's one more thing from the source that I want to unpack.
Okay, I'm intrigued.
The author specifically called out the financial industry. They said it's rigged against the individual investor.
Right.
That's a pretty serious accusation. What do you think they meant by that?
That's a great question, and one that deserves some thought. The author didn't pull any punches in their critique. They basically said, the system is designed to benefit Wall Street and big institutions at the expense of everyday people.
So they're saying the little guy doesn't stand a chance.
Not necessarily,
Yeah.
but they are pointing out the power imbalances
Okay.
and the conflicts of interest
Yeah.
that exist in the system. They talk about things like high fees, hidden costs,
Yeah.
complex financial products that are hard to understand.
No, right. So it's not that individual investors can't succeed, it's that the playing field is tilted against them.
Yeah, I think that's a good way to put it. The author argued that traditional financial advice often just reinforces that imbalance.
Okay.
Encouraging people to invest in products that generate high fees for the industry,
Right.
but don't really deliver great returns for the investor.
Okay, so if we're accepting this premise that the system is rigged, what can we do about it? Like, how do we level the playing field?
That's a big question,
Yeah.
and there's no easy answer. But I think it starts with awareness.
Okay.
The more people understand how the system works, the better equipped they'll be to challenge it
Right.
and demand change.
So education is key.
Absolutely.
Mm-hmm.
We need to empower people with the knowledge and the skills to make informed decisions,
Right.
understand their rights as investors, and hold the industry accountable.
Yeah, that's powerful. And I think it's also important to remember that, we're not totally powerless.
Right.
We have choices. We can choose to invest in companies that align with our values. We can choose to support financial institutions that, prioritize transparency and ethical practices.
Yeah.
And we can choose to advocate for policies that promote a more just and equitable system.
Absolutely. It's about taking back control,
Yeah.
being informed consumers,
Yeah.
and using our collective power
Yeah.
to drive change.
I love that. It's about shifting the balance of power.
Yeah.
And creating a system that works for everybody, not just a select few.
Exactly.
Okay, so before we wrap up this part of our deep dive, I want to pause for a moment and ask you, our listener, a question.
Okay. I'm curious.
The author's critique of the financial industry is definitely something to think about, but it's also important to consider other perspectives, right?
Of course.
Do you agree with their assessment? Do you think the system is rigged? Or do you think there's more nuance to the story?
Take some time to think about your own experiences,
Yeah.
what you've observed, and what you've learned in this deep dive. What conclusions have you come to? We'll be right back to explore these questions further and look at some potential solutions for building a more equitable financial system.
Okay, welcome back. So I hope you had some time to, really think about that question. Is the system rigged?
Yeah.
It's a tough one, right?
It is.
There's no easy answer. But even just asking the question, it gets you thinking, doesn't it?
Absolutely. It challenges assumptions.
Right.
And I think, it's important to remember that the financial industry, it's really complicated.
Yeah.
There are so many different players, so many different motivations, and a lot of history that shapes how things work today.
So even if we don't have all the answers right now, just starting a conversation about fairness, about access, that's a step in the right direction.
I think so. And remember, even if the system seems daunting,
Yeah.
we're not powerless. We have agency.
Right. And that's something the author really emphasized, right? Taking control.
Yeah.
Not just accepting what the so-called experts tell you.
Exactly.
Yeah.
Yeah.
Earlier, we were talking about how the author achieved those, amazing returns in just 3 years.
Right.
And it's easy to focus on the what, right? Cash value, life insurance, real estate.
Yeah.
But maybe the bigger lesson is the how, their mindset.
Absolutely.
Yeah.
They didn't just follow conventional wisdom.
Right.
They questioned it.
Yeah.
They found alternative strategies, and they built a system that worked for them.
Right.
And I think that's really empowering.
It is, especially for anyone who feels stuck.
Yeah.
Frustrated with their finances.
Totally. It's instead of playing the game by someone else's rules, you learn to play a different game.
Right. And it kind of brings us back to that question we were asking before, right? Like, if minimizing loss is the top priority, what other strategies might achieve similar results beyond, the specific things that the author did?
Right.
I mean, where could we look?
Well, I think there's a whole world of alternative investments out there.
Okay.
Real estate, like the author did,
Yeah.
but also things like precious metals, commodities,
Mm-hmm.
even digital currencies.
Mm-hmm.
Each one has its own risks,
Right.
requires research,
Of course.
but it's about diversifying.
Right. So not putting all your eggs in one basket.
Exactly. And diversification goes beyond just asset classes, too.
Okay.
It can also mean diversifying your income streams.
Oh, interesting.
Building a side hustle,
Mhm.
starting a business, investing in skills that make you more marketable.
Yeah. So it's not just about where you put your money,
Right.
it's also how you earn it.
Exactly.
That's really interesting.
Yeah. It adds another layer to that idea of minimizing loss,
Yeah.
right? Making yourself more resilient
Yeah.
to things like economic downturns or job losses.
Right. And let's not forget the power of education, right? Like investing in your knowledge,
Oh, yeah.
that can be one of the best investments you ever make.
Absolutely.
You know?
It helps you make better decisions,
Yeah.
negotiate better, create more opportunities.
Yeah. Wow. This has been a really, thought-provoking deep dive.
It has.
We've explored, this incredible success story,
Yeah.
questioned conventional wisdom,
Mhm.
even kind of challenged the system itself.
Right.
And I hope our listeners are walking away feeling empowered.
I hope so, too.
They have the ability to shape their own financial futures,
Absolutely.
even if the playing field isn't always level.
Right. And I think the author's story is just one example
Yeah.
of how thinking differently, taking calculated risks
Yeah.
can lead to amazing results.
Right. And even if their specific strategies aren't for everyone, the principles are universal.
Yeah. Minimize loss,
Mhm.
seize opportunities,
Mhm.
be proactive.
Mhm. Be a learner. Yeah.
So to kind of wrap things up,
Okay.
let's leave our listeners with one final thought.
All right.
If you were to adopt that mindset, right?
Mm-hmm.
Minimizing loss, taking control,
Yeah.
what's one step you could take today
Mm-hmm.
to start putting those principles into action?
Right.
It doesn't have to be huge.
Yeah.
Read a book, call an advisor,
Mm-hmm.
maybe even just have a conversation with a friend about your financial goals.
Right.
The key is to start somewhere
Yeah.
and keep moving forward.
Absolutely.
So that's all for this deep dive. Thanks for joining us.
Yeah.